Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Also, I'll just let you have a look at a couple of the disclaimers that we have that we need to show you. Just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. So we'll follow the normal format that we usually use for this webinar. So we'll firstly just check out how markets are shaping up today, middle of the week, Wednesday. We'll then just check out one small theme about market expectations for Fed rate cuts and or potentially just rates staying where they are for a prolonged period, of course. That has been a key driver of markets, a key driver of treasury yields, and therefore the US dollar and other currencies and risk markets as well. We'll then do a bit of a deeper dive into stocks, and especially Nvidia and Nvidia's results, which are of course due out after the US close today. We'll just check out some of the stats around Nvidia, and obviously it being a key driver again of the US stock indices as a major part of course, the index, along with the other magnificent 7 stocks. We'll look at that in general. We'll look at some of the technicals around the S&P, the NASDAQ, and the Dow as well, as we normally do. After that, we'll briefly check out last week's key data points, really important US CPI data, of course, as well as then looking at the DXY, so that's the dollar index, technicals around that, before then reviewing as well the UK data out of last week, key for the sterling, key for cable, so sterling against the dollar. We had the CPI data, of course, as well as some important numbers, including key wage data, which the Bank of England looks at. We'll then get into some other highlights for this week, chiefly the PMI data, which is a leading indicator, so crucial for policymakers. And we'll look at the Eurozone PMIs, we look at euro against the dollar, and then touch upon probably the Fed minutes, which are out later this evening as well. Okay, quite a lot to get through. Markets generally at the moment shaping up well. Big tech actually dragged US equities lower ahead of Nvidia's earnings, of course, later after the bell today, the US closing bell, that is. Investors kind of turning cautious. There wasn't any news that we could make out, but the stock Nvidia was down over 4%, down over 6% at one point, closed down for over 4% in the end. As we say, little news to drive that sell-off, really. Investors potentially turning cautious on whether, of course, the stock can continue to meet sky-high earnings expectations. China's rate cut to the 5-year LPR, that provided some support to Chinese and Hong Kong stocks today. In fact, the benchmark CSI 300 index, that's now up over 10% from its recent lows. Interesting, really. There's been official ETF buying. There's been some administrative error measures as well. I think we just had a measure around the open and the close just announced. I just heard as well on some of the major indices in China starting soon. So that's all driven this rally, but then some are questioning its durability. Really, it's whether we get follow-up measures along the way in the near future. We did have the March plenary meeting as a big key date for potentially major measures being announced, but at the moment it looks like we're getting a drip feed of smaller stimulus measures as well. Yesterday as well, we did see softer Canadian CPI data, and that really cooled global inflation concerns. And there is, interestingly, some chatter that even the January US CPI data was perhaps a slight aberration, and that the disinflation trend will be restored in the February CPI figures, which are released on March the 12th. We also had Fed speakers actually questioning, or not really questioning, but just pointing out, of course, it was just 1 month's data. They want to see a series of data which suggests prices are cooling. They're happy with it at the moment, but want to continue to see that theme over the next few months, of course. That Canadian CPI data actually did trigger a massive or pretty big front end move in yields. They dropped 12 basis points, actually brought forward rate cuts modestly, made the Canadian dollar the underperformer in G10 FX. Yes, just one theme we wanted to touch upon, first of all, is the fact, of course, that markets have come a long way since the start of the year, since really before then. And I just want to bring up something that we have used quite often over the last year, quite a few months, which is this CME Fed Watch tool. It basically shows you what Fed funds futures are pricing in for specific Fed meetings. So the next meeting is the 20th of March. Hopefully you can see that here. Let me just double check. I'm just checking you can see this. I'm pretty sure you can. So this is the CME Fed Watch tool, as I say. It shows you in a really decent way with a bar chart what is priced in for the Fed meeting. So the next meeting is the 20th of March, of course. We are nailed on now for there to be no change. But if we just look down, we can see a rate cut, of course, was priced in only a month ago, a 46% chance of that. That was the 19th of Jan, but at the start of this year, the chances of that were above 70% or so. Of course, that has now changed, and you can see the May odds of a rate cut now, just a 1 in 3 chance really of a rate cut, 25 basis point rate cut really, whereas there's a 66% chance that rates stay where they are at 5.25% to 5.5%. Even in June, the chances of a rate cut really now sort of 56% for a 25 basis point cut, 23% for a bigger cut. But these obviously have been, rate cuts have been pushed out, and that has been a key theme for the dollar and for markets, of course, over the last few months. As I say, we've come a long way then across 2024, really. 2 rate cuts now are fully priced in by or for this year. That is 2 rate cuts have been priced out for 2024, and there's now less than 100 basis points priced in. That, if you remember, that was probably around and above 150 basis points of rate cuts priced in at the start of the year for this year. Interestingly, sort of less than 100 now, around 90 even, actually, I think. That is much closer to what the Fed expected in its December dot plot. If you remember that, they bumped up their forecast by a 25 basis point rate cut from 50 to 75. So they expect 75 basis points of rate cuts for this year. That's at its most recent dot plot. We do, of course, get one at the March meeting. So on the 20th of March, we get an updated dot plot, updated summary of economic projections as well. So key date for markets, the 20th of March, of course. But currently, yes, they expect 75 basis point of rate cuts. That is indeed what Fed Chair Powell said at the January meeting as well. And currently, markets, as I say, pricing in around 90 basis points, so much closer to what the Fed has said. It does spring to our mind anyway, don't fight the Fed, that phrase, that well-known phrase, and markets sort of coalesced much closer to, yes, that December dot plot. That could mean, I guess, that the dollar trends could remain uninspiring for now. That's a possible sort of thought across the market, I guess. However, the delay in the first Fed rate cut expectation from March to June does beg the question as well on whether the Fed will be leading the rate cut cycle again. And some other major economies, Eurozone, of course, the Swiss economy as well, possibly face imminent recession threats. And their central banks may not be in a position to wait until sort of mid-2024 to cut rates. So then that gives us this idea, this theme that potentially then we get this divergence, this bigger divergence really now between different central banks. Previously, probably at the start of the year, there were thoughts around, the theme was around synchronized rate cuts more or less between the major central banks. Now there is this slight divergence, whether the Fed leads on rate cuts, whether other central banks may lead instead. And then also now, interestingly, not sure about this, but whether then rate hikes are being put back on the table. I think Lawrence Summers, a previous US Treasury Secretary, I think he mentioned this, but possibly, yes, you will get more thoughts about that, even though they remain pretty unlikely to us anyway. Yes, so yeah, interesting theme. We thought we should bring it up really, and this shift really around pivots. If you remember the Fed pivot, which we haven't seen just yet, but of course markets do pivot around the pivot, if you like, and really it's this idea about competitive pivots really, and how central bank divergence could play out before then we potentially get back to that sort of synchronized central bank easing cycle. That's generally what we do see. History tells us that, but obviously around this key turning point, then we are going to get different viewpoints, and obviously that's how markets play out. Yes, we thought we'd touch upon that theme. Otherwise, closer to home for this week at least, it's all about stocks and it's all about Nvidia. If you just bear with me 1 sec, I'm just going to pull up a couple of charts then for or around, of course, tech and the Magnificent Seven. We did use this chart, I think, a couple of weeks ago. It just shows you the divergence, like that word at the moment, between the Magnificent Seven stocks. We can see Meta, of course, doing well recently. Nvidia, certainly the current market darling, if you like, of markets for sure. But then you've got this divergence and this weakness in other parts, other names in the Magnificent Seven. So Tesla for sure is struggling. You've got Alphabet and Apple as well. Apple negative, still negative, I think. If you look at this, well, the FT have done this. Basically put the performance to zero, and then you can see more clearly the divergence between these 7 stocks. We bring that up, but generally we have had, of course, stunning gains in the Magnificent Seven. That's been the story of the US stock market over the past year. And of course, as I said, that leader really at the moment and has been one of those mega cap tech and growth stocks has, of course, been Nvidia. We get those results very soon in the next few hours. Its stock rose, I think, close to 240% last year. It's up, was up over 50% this year before the brief, or before yesterday's sell-off anyway. And the chip maker really at the center of the excitement over AI and the mania in a way that we've seen driving indices. Nvidia, again, just pulling up this chart, is now surpassed Amazon and Alphabet now in market value. It's now the 3rd biggest US company, or 3rd biggest company in the world by market cap as of February 14. A small caveat there, but I think that still sticks. As such, mammoth stock gains stand really to raise the bar for its results, and really any disappointment potentially has really then a broad market fallout given Nvidia's growing heft in major indices and of course its importance to the outlook for AI's financial promise and future. Interestingly, again, Nvidia has well, the fourth largest weight on both the S&P 500 and the Nasdaq 100. It commands, I think, 4% and 5% weighting on each index respectively. So you can just see just from its stock alone, and then really around other AI sort of based linked stocks, the mega cap tech stocks, of course, the Magnificent Seven as well, just the huge bearing that potentially these results will have on the wider market as well. As for the numbers, I think analysts expecting to report quarter earnings of $4.56 a share on revenue of 20.2 billion, and with an adjusted gross margin of 75.5%. We think the big number everyone will be watching is the data center revenue segment. That generates by far the vast majority of Nvidia's revenues. Its forecast is to come in at 16.8 billion, 16.8 billion. And then for the fiscal first quarter, analysts forecasting earnings of $4.85 a share on revenue of 21.6 billion, with an adjusted gross margin similar, 75.5%. Key then will be, as we say, that data center revenue segment, and then of course commentary and guidance, and really the tone of the outlook from the CEO, and really whether that inspires investors, really notably around those long-term data center sales. Also, it'll be interesting whether there is still decent supply from TSMC, and whether that supply can meet, of course, demand. And then, of course, some of the other Magnificent Seven stocks actually have been just mentioning, of course, their spends on AI in the future, and of course any hints around whether that holds up or whether that is flexible and potentially weakens, then of course that will have an impact. I think interestingly as well, if we look at the options market, and I know this has been floated around, we look at it from time to time with the expected moves on the day. So the implied expected move of for the day, after the results, that sits in an impressive, double-digit plus or minus move. So I think it's around 11% plus or minus in either direction. Option markets pricing for the Nvidia stock to move, and that is of course on implied volatility for a company with a market cap of above $0.8 trillion. So yes, potentially significant implications. As I say, the move in Nvidia share price would likely spread into other AI and mega cap tech stocks, and of course then the broader indices as well. If you think Nvidia, Microsoft and Meta account for about half of the gains in the entire S&P 500 so far this year, and then together with those other Magnificent Seven stocks, as well as kind of a tumbling Tesla, if you like, they account for then greater than 25% of the index's entire market cap. So potentially we get moves in equity futures, equity indexes, of course, because it's after the close. So check out the grey market, of course, check out where Nvidia will potentially open up. And potentially then that could even impact the dollar, of course, risk FX, like the Aussie dollar, Kiwi dollar, and even NOK as well. If we just pull up, actually, it's worth pulling up the Nvidia stock price chart, which let me just get here, which hopefully you can see now. Of course, consecutive weeks of gains. If I just pull up the weekly, you can see, yes, that was the gain from last year, 233%. I said a bit higher than that, but you can see consecutive months of gains, very few pullbacks, pullbacks being buying opportunities. Yes, then just over a 50% gain at the intraday high. The intraday high for Nvidia, $746.11. That intraday high, which was, yes, when last Monday, and we've just been sort of consolidating around there before then. Interestingly, there's just this sell-off yesterday, as I mentioned, down 4.35%. You can see here, down to 694.52, which is just above this fib level that we put in from this December low up to the intraday high, the all-time record high, of course. That first fib level at 693, we're just above that at 694 yesterday. Otherwise, then we've got these Keltner channels here, which don't really prove of much use, because obviously we can trade out of that upper band for quite some time, which is a prime example here. But generally, if you look, it's interesting, when we do trade out of that upper band, then you see that nice retracement, which has happened on numerous occasions until, of course, this year, where we've had consecutive weeks of gains. Anyway, yes, you can see a pull back then to 672, which would be the middle of the Keltner channels for us anyway, similar to Bollinger Bands if you use those. Then the next sort of major fib level will be down at 641.59. That's the 38.2 of that retracement, which, if I'm just working it out, would be around 12% or so of where the closing price was. Let me just check that. Well, it's a bit lower than that, but yes, you can see 694. Just bear with me 1 second. I just want to check something out. Yeah, of course. So 694, 10% move lower would be 625. That would be below the 38.2, which is at 641. Yes, so I'm just kind of giving you a sort of idea of what option prices see, of course, and where potentially we can go. That's just a downside move. Obviously, Nvidia could surprise us to the upside, and potentially then obviously a 10% move higher on 694 would take us towards above 750, at least above that all-time high at 746, above potentially 760 is a 10% move. So yeah, potentially big moves coming. Yes, just be aware of that after the US close, of course. Okay, otherwise, it's worth looking at, of course. Yeah, the major stock indices. Sorry, I was just checking out what you can see, guys. Hopefully you can see what I'm pulling up, of course. We've got the S&P 500 here. Just come off its highs, of course, again, sort of overbought on the RSI. You can see momentum indicator, as well as trading through the upper band in these Keltner channels. Again, you can see sometimes we can trade along the upper band for quite some time, many months in fact. So just to guide, and always suggest using other indicators as well, and hopefully you do that. So just off these highs, that all-time high at just above 5,000, 5,048, 5,000 obviously a key psychological level. We've just pulled in some sort of swing lows. We've got one at 49.20, probably initial support, then the next one at 48.45, and this long dotted line here is the previous record high at 48.18. So yes, just a few levels there to look at. That's the 200-day moving average, the black line, so we're way above that. If we just pull up the 50-day, for example, well watched level again, that's sort of around the all-time previous high, that of 48.18. So that's in the S&P 500, the broad benchmark index, the Nasdaq 100. Again, interestingly, we probably got this swing low here at 17,478. You can see we dipped down to below 17,400, but then closed above it, the 17,546 yesterday. So interesting, buyers stepping in, I think, later on in the session. Yes, you can see that on the 50-minute chart there, dipped down and then buying through the latter hours or the last couple of hours in the session. So closing nearer the highs, interestingly, but just broke down through that near-term upward trend line that you can see there, that dotted line, which is here. First sort of swing level below this would be 17,128, and then sort of 17,042, and you've got the 50-day moving average, that black line at 17,128. So those are levels for us in the Nasdaq 100. For the Dow, interestingly, haven't come off so much. We had Walmart's decent numbers out yesterday, I think. And yeah, so we're just not that far off the record high. That's at 38,927. Just consolidation, really, unless we go and break this swing low from 13th of February. That's at probably initial support for us at 38,039. And then below that, you've got the 50-day plus probably these levels here, which tally with the 50-day, actually, a 50-day moving average on the Dow at 37,779. Okay, those are stocks. Let's now go to, just quickly, as I said, just a recap of the last week's main data. We had US CPI, of course, overall, the inflation report for January, hotter than expected on all accounts, really, and that pushed back again money market pricing on those rate cuts. Hot report coupled with, of course, the strong January jobs report as well shows really that the final stretch of the Fed's fight to return to the 2% inflation target, of course, will be bumpy and uneven, and arguably as well the hardest part of the fight. Those numbers then, the headline saw the month-on-month accelerate to 0.3% versus, well, previous and expectations of 0.2, and then that year-on-year number easing, of course, to 3.1 from 3.4, but certainly not as cool as the 2.9 forecast. For the core, that rose 0.4%, so above the 0.3% forecast, with the year-on-year maintained at 3.9%, despite expectations for a decline to 3.7%. And then just briefly within the report, shelter, that continued to rise in January, increasing 0.6%, contributing over 2/3 of the headline inflation, both in the year and on the month. And there was, well, other medical care services, motor vehicle insurance also saw strong gains, although they are much smaller weights in the basket. But arguably, I mention those because each of these factors really a consequence of supply dynamics, really against demand, and potentially not a major concern for the FOMC, particularly with inflation expectations in retreat. I did mention sort of shelter services, less rent of shelter, they rose 0.6%, so accelerating from 4%. Probably though the main point to take away is that, well, you can see we've got the headline falling, although sticky. We've got the core of the blue line falling, which is encouraging, and then you've got the CPI number for services, less shelter, which is still sticky and potentially rising. But the sort of main takeaway, we said, is probably that it's still now tracking below the FOMC's target on a sort of wider 6-month basis, and potentially by mid-year then the annual rate is likely to be much closer to the target. That is, of course, of 2%. Just pull up this chart as well for you. The Fed's favored inflation gauge is the core PCE index. That is much closer to target. That has been falling, although certainly now expectations for the February 29 release of this data, which will be a key data release, a key risk event, potentially expectations estimates being put up slightly after the CPI tick up. But generally, just want to show you this chart because obviously you've got the CPI headline there, but you've got then the CPI core, those orange lines, but then the blue lines are the PCE headline and core, which are much closer to target. And as I say, that will be a key risk event for markets on, I believe, February the 29th. Okay, we did have as well, actually, we just touched upon retail sales out of the US last week. They did actually disappoint, so not really in line with all this data that we've seen recently in recent weeks, which has seen upside surprises. Retail sales, they did disappoint, so a decline of 0.8%. And well beneath the negative 0.1% consensus reading, and below, of course, last month's plus 0.4% reading. Retail sales ex autos, they were also down 0.6%. Expectations were for plus 0.2%, and the previous was plus 0.4%. And then the super core, so that's kind of taking out gas and autos, that came in at negative 0.5%. Previously, that was plus 0.6%. So seasonality, certainly, and weather, that had an impact, but it is kind of worth watching. Potentially, again, conflicting stories, potentially around sticky inflation, whether that stays high and then potentially impedes consumer confidence, and of course then consumption trends in the US. Yes, so that's the data really we had. Friday as well, producer prices again rose more than expected as well. Should touch upon that. Kind of echoes that stronger than expected CPI release, with services costs being the main culprit again, although there were sort of one-off January effects to that. Okay, that's all the US data. There's not too much out. We'll touch upon it shortly, but we'll just go to the DXY chart, which is here. And hopefully you can see what we're putting up on the charts, and what you can see. This is the DXY chart. You can see a decent bounce back from this low from late December, below below 101, the low at 100.61 on the DXY index. Remember, this is the dollar index against a basket of 6 other currencies, big trading partners, but the euro has by far the biggest weighting, around 57% or so of the weighting. So always remember that. The next couple of currencies are sterling and yen with around 12-13, I think, % or so. So a much smaller weighting, very heavily weighted towards the euro, don't forget. But anyway, decent rise, which has come obviously on the back of these rate cuts being reined in. Interesting sort of charts, really. You get a big break to the upside and then consolidation, big break to the upside, consolidation, break to the upside, consolidation, break to the upside, and then we've just pulled back. So interesting, really. Found resistance at this fib level for us anyway. That's the 61.8 of the Q4 sell-off, which is at 104.63. So we mark that as resistance. You can see that did work as well earlier on this month, and then of course last week as well with that upside break. Have found support around the halfway point of this move. That's at 103.86, so that'll be interesting. That held previously and has held again yesterday at least. Whether we then do bounce off this back up to sort of 104.63 or break down below, and then we're back in this sort of range that we saw in January with the 50-day moving average, and then the next fib level around sort of just above the 103 level. Okay, that's the DXY. If we now just look at that UK data as well out of the UK last week. We had firstly the CPI data. Well, just before we get the CPI, actually, we had the employment data actually last Tuesday. That was stronger than expected. Unemployment, well, that declined, but we like to put a caveat on that, as most sort of people, economists, workers in the city on Wall Street anyway, that look at these numbers, have a caveat around the unemployment data. The statistics not that robust at the moment, but yes, they did tick down, did tick lower. Change in the payrolled employees, that printed higher as well, an upward revision for December as well. But really for us and the MPC and the Bank of England, the key number in the employment report is the average weekly earnings. They cite that and have cited that on numerous occasions, as well as services inflation, which we'll look at shortly. But as for wage growth, well, that slowed from 6.7 to 6.2%, but was higher than the 6% expected. Of course, then the following day we had the CPI data, kind of welcome figures, contrast to those wage growth figures anyway. Headline and core figures came in marginally lower than expected. You can see here the headline 4%, unchanged from December and 1/10 lower than expectations. Then the core, that held up 5.1%, but below the forecast 5.2%. And then, as I said, the key number is the services inflation number, as it is across many, across many central banks at least. And that services inflation number, that came in at 6.5%, as I have here, so below the forecast 6.9%, below the expectation of the Bank of England at 6.6%, though it was 1/10 higher than the December figure of 6.4%. So encouraging, but certainly still lofty. And we've got in here, of course, the core is still more than double the target rate of 2%. And as I've said, high services inflation, high wage growth still an issue, probably for the majority of the MPC. Other data as well. Last week we got GDP data, although that is obviously lagging, a lagging indicator. It did show us that, or confirmed that the UK was in recession for Q3, Q4 last year, 2 negative prints of a GDP. But I should probably say, well, even the Bank of England's man said recently, GDP data is backward looking, as I've said, and really forward looking data is looking more positive. And that's probably key for us. A lot of economists citing that potentially not sort of amazing figures, but slightly modestly more positive than what we have seen in the UK going forward, that is. One data point actually highlighting that in a way was Friday's UK retail sales. They jumped 3.4%, more than double forecasts. And as I say, the data suggests the economy may be recovering from the sort of late year drop in activity, although of course trends do remain soft. Yeah, so that's the UK. We'll look at, bear with me, we'll just look at cable as well. Interesting for us, we did get, that's the DXY, just bear with me, you can see cable here. Overnight actually, last night we did get, interestingly, some sort of mildly dovish comments from the Bank of England's Governor, Andrew Bailey. He said it was not necessary to wait for inflation to come back to target before cutting rates. Adding also that the bank was particularly focused, as I've mentioned, on services inflation and wage growth, and wanted to see those on a sustained path towards headline inflation. Should also mention for sterling traders, there is this figure out there now, 23 billion, which is a number cited for Chancellor Hunt in his March budget, potentially to give away, if you like, in tax measures, and that could potentially be a stimulus, fiscal stimulus, and then potentially help sterling going forward. That's just something to look out for in the next few weeks. Otherwise, for cable, you can see, interesting really, we still got this range in here, this range sideways trading bracket, which we should probably extend, although we did break out of it, so it's probably negating now that range. But if we keep it in there, yeah, 126, 128, 28 is the sort of range that we did have. We broke down below towards 125, 125.18, that low, which tallies with this fib level, 125.25. So that acts as support, again, did so before then. Now we're back towards and above 126 at the moment. You've got the 50-day moving average there. That might be initial resistance. That's at 126.74. Otherwise, below that, initial support for us now at sort of 125.25 in that region. That is sterling. Okay, otherwise, what do we have this week? Just checking out the time. Hopefully you guys are all with us. Yes, you are. So that's really good to see. If you do have any questions, I should add, of course, please do type those in the question box. I think you can see that. Really, any questions you have on any of the setups, anything we've been talking about, anything coming up, please do ask the question, any questions, and I'll try to answer them as best I can. Otherwise, yes, let's now go to, we'll just show you quite an interesting graphic, which is about the PMI data. This PMI data is basically businesses' surveys for manufacturing and services. It's a leading indicator, so it really gives us a good picture of how economies are shaping up. I do like this chart, which was produced by Reuters, and it just shows you, it's a heat map really, and just shows you across the world really how these PMIs have looked over the last 12 months. You can see red or the brighter color being a number above 50, which denotes, of course, expansion, whereas the blue numbers are below 50. They denote contraction. It's that sort of boom bust level, if you like, above 50 contraction, below 50 above 50 expansion, below 50 contraction. So you could see economies were looking good, but then moving through last summer, we had a dip, especially in the Eurozone. You can see down below to sort of 47 in the Eurozone composite. This is the joint services and manufacturing numbers combined. They dipped down to 47 or so for the Eurozone. You can see France and Germany down to 44, 46, 45 even for Germany, 44 for France. But now, well, France still stuck there. Germany slightly picking up. And then you can see sort of relative to the UK, US, well, UK did dip down to 47, but now picked up very nicely actually to 53. And similarly, well, the US didn't quite drop below that 50 boom bust level, and then is picking up to 52. As for these numbers, they're released tomorrow. They should show sort of renewed strengthening in manufacturing. Regional PMIs published this, well, last week in the US. They point in that direction, as do indicators from several Asian countries that are normally leading in the manufacturing cycle. Flip side, surveys might point to continued weakness in services, which at least in the euro area seem to be sort of stagnating or contracting, albeit with rising prices. So Eurozone PMIs, they are generally the most important because, for example, in say the US, we get ISM data, which has been really perceived as the more important data, but that's not to say PMIs don't move markets, of course. But the Eurozone expectations are for manufacturing to increase to 47.1, for 46.6, services to rise as well. And then that is potentially seeing the composite tick up again from 47.9, so this was rounded, of course, to 48.5 is the expectation. So the outlook sort of generally appears less gloomy. That January figure hit a 6-month high, but or as well, the bloc really avoided recession late last year, but is still in that contractionary territory. As I say, though, the outlook is possibly picking up in Germany, to a lesser extent in France, as I pointed out, but potentially we could see some improvements as the year progresses. From a policy perspective, inflation and expectations over wage growth remain the core focus for the ECB, but of course a soft report could prompt a dovish swing in market pricing. Currently, that stands as well. April is seen as pretty much a coin toss for a 25 basis point cut, with the first reduction fully priced in June. And then as a whole, I think there's around 100 and just less than 110 basis points of price cuts or policy easing across this year as a whole. Interestingly, just would touch upon the fact that, well, the internal debate at the ECB continues to be interesting and varied. We had a sort of more centrist Villeroy caution recently that cutting rates too late could entail an over adjustment, while then we had the hawk Schnabel who said that the ECB must be cautious not to adjust policy prematurely. Differences of opinion, of course, it's a big governing council, but they probably support the idea, consensus probably thinking that June is still the more likely time for the ECB to start easing rates, and that would, of course, be really a sort of classic European compromise. If we now just look at well, euro-dollar, just to finish things off. Let me just grab the chart, which is here. Again, I'm just checking you can see what I'm seeing. Hopefully you can, because it's not showing me. Just bear with me 1 second. Just got a technical issue here. And hopefully you guys can see what I'm seeing, which I'm not sure why possibly you can't, but nobody's saying that you can't. So I'm presuming all is good and you can see what I'm seeing. I've got the euro-dollar chart up here just to finish off with, really. You can see a nice sort of descending channel. Again, I remind you, similar to the DXY, but you basically mirror it, put it the other way. So we topped out at 111.39 late last year, of course. Then we've had this nice series of lower lows, lower highs in a bear channel, effectively. Yesterday, we popped out of that bear channel. You can see we had a high of 108.38, but we're just potentially clinging on to the top of the channel there. Depends where you put the line, really. So still trading now, well, below 108. The halfway point of the Q4 rally, that was at 107.93. You can see there. If we do manage to hold the gains through the top of this channel, then potentially we go up to 108.75, and you've got the 50-day moving average at 108.89 as well. Otherwise, if we do roll over, potentially then back into the channel, then certainly 107, 107.12, which is the next fib level, is probably major support, which held up prices previously at, well, last week, effectively. Okay, I don't see any questions. Hopefully that's proved of use to you guys. Really, really, really good having everyone on the call. Really do appreciate your time. And hopefully, as I say, that's been of use to everyone. A big evening, really, of, well, the Nvidia results to come out soon. Do take care out there, and we will speak to you in a couple of weeks. Okay, bye-bye for now.